If I were to ask you, what is the number one problem with whole life insurance? Meaning, where do people have the most regret or buyer's remorse? They look back and say, I wish I never would have took out a whole life insurance policy. When does that occur? This typically occurs when one is interested in a whole life insurance policy specifically for the cash value. They're told about all the benefits of the cash value. They hear of and see wealthy individuals and corporations putting a ton of money into whole life insurance products, again, specifically for the cash value. Let's pretend you're this individual and you see this going on, and you say, I want that product for the cash value, just like those wealthy individuals and corporations. So you take that policy out, you open it, you put money into it, and then afterwards, you find out that the policy was not maximized for cash value. This is the biggest problem with whole life insurance. Now, why it occurs is due to a number of reasons. It could be due to a lack of information, maybe a lack of transparency. Perhaps the agent was not comfortable selling a policy that maximized the cash value because they weren't comfortable with minimizing their commission. You'll see that's how it works. If the cash value is maximized, the commission will be minimized. There could be a variety of reasons as to why your cash value was not maximized. So what we'll talk about today is how to identify that problem of a policy not being maximized for cash value, and then how to avoid it and make sure that a policy is set up for maximum cash value. So what we've got here first is identifying the problem. The easiest way to tell is to look at the first year cash value. So if you're paying any dollar amount into a whole life insurance policy, it could be $10,000 per year or $100,000 per year. How much of that payment shows up in cash value in the first year? If it's a zero, that means it is a traditional whole life insurance policy and a great example of what not to do. This is the problem. If it is 50 or 60% of your initial payment, that is not maximized for cash value. We want to look at the first year cash value. The second thing we want to look at is the break-even point. The break-even point, what that term represents, is the first year that the cash value is equal to or greater than your total payments. So for example, if you paid $10,000 per year, in the first year, you've paid a total of $10,000. If your cash value is zero, that's a 100% loss. That's not good at all, but you have not broken even. Let's assume by year 5, you've paid a total of $50,000. That's $10,000 per year for 5 years. That's a total of $50,000. We'll assume that your cash value is worth $30,000. You have not hit the break-even point because you have less money in cash value than what you've paid into the product. Let's assume by year 10, you've paid in a total of $100,000 and your cash value is $99,000. You still have not broken even. Year 11, you've paid in 110, your cash value is now 115, you've hit your break-even point. The first year that the cash value is equal to or greater than your total payments. Let's look at an example of this. And again, this is identifying the problem. So this is what is referred to as a traditional whole life insurance policy. As we look at this, we see how much money per year is being paid by this individual. $100,000. We've got a lot of columns here. Here's the money column. So if he's interested in the cash value, this is his first year cash value. It's a zero. By the 10th year, he's paid in a total of how much? $100,000 times 10 years is $1 million. His cash value is $800,000 and change. That's almost a $200,000 loss. It's by year 14 when he finally breaks even because he's paid a total of $1.4 million. And his total cash value has hit $1.4 million, slightly higher. This is a problem. Imagine if you take out a whole life insurance policy, you're led to believe that this policy is maximized for cash value or set up for high cash value, and then find out after the fact that it's not. You're going to see a proper example in a minute. So that's identifying the problem. How do we avoid it? Here we go. First year cash value. This is what we want to look at. it should be typically between 80 and 90% of whatever you pay in. So in that exact same example, if I'm paying $100,000 per year instead of a zero, I should see somewhere between $80,000 and $90,000. Now, what if it's in between these two? What if it's 50% or something like that? No, I would still aim to maximize the upfront cash value. This is how I will avoid the problem of the cash value not being maximized. The break-even point, instead of taking 7 to 10 plus years, should fall somewhere between 3 to 6 years. Let's look at a quick example here. Here's $100,000 per year going in, same out of pocket. This is actually the same life insurance company. What do you notice under the money column? The net cash value in the first year, just about 90%. The break-even point being the first year that the cash value is equal to or greater than his total payments is year 4 instead of year 14, $400,000. The difference between these two, while the out-of-pocket is the same, the premium piece is 10% of what it was in the last example. So his minimum premium is $10,000, and then we've got the rest going toward other riders that primarily build the cash value. So this is set up for maximum cash value. Another example with a different company, same thing here, 100 going in, first year cash value, about 88% break-even point, also year 4. This is a different company and product. Both whole life though. So we've got an example of what not to do, or that's how we identify the problem, and that's how we avoid the problem. When you look at corporations and wealthy individuals, if you copy them with respect to what they do with whole life insurance where cash value is the goal, you'll have a policy that's similar to the second example we looked at, which was avoiding the problem. Rich cash value up front, early break-even point. If we were to look at the guaranteed values, you'll see more money from start to finish with those. The guaranteed values with a higher upfront cash value policy, that is. The cash value, here's why these individuals, well, the corporations and wealthy individuals are attracted to it. Safe, liquid, and tax-free area to position money. It is tax-free, provided we do not trigger a taxable event, which we've got other videos that discuss that. But here's really what we've got. A safe area to position money. The net growth rate typically falls somewhere between 3 to 5% over the life of the policy, not in the early years. As we did see, it was negative in the first year. But as time passes, somewhere in that neighborhood, it's liquid. We can access it similar to a personal line of credit. And then the tax benefits are attractive to a lot of individuals, especially those in higher tax brackets. So when taking out a policy, the problem here, when the cash value is not maximized, is typically because we don't know how to avoid the problem. We don't know what to look for. And it can be confusing. Even here, we've got 2 bullet points, but still, there's a lot of columns on a life insurance illustration. There's a lot that goes into it. It can be overwhelming. You may have felt like this before. But the steps we need to take in order to make sure that a policy is set up for maximum cash value is either A, know what to look for and know what questions to ask, or B, hire someone to review the policy for you before starting it. That is critical because after you start a policy, you have a very, very short period of time to make any adjustments to that policy. It is somewhat set in stone or you're locked into it after you've started. So it's important to be aware of that. But you can hire some individuals, whether it's an actuary. Some attorneys are familiar with cash value life insurance. There's a couple that we work with that know what to look for and know what questions to ask. Or you can speak with multiple agents and compare and contrast illustrations to see which one gives you more cash value, particularly up front. But with that said, company selection is important there as well, because when you look at life insurance illustrations, different companies will project different values depending on what year the illustration is run. Meaning I can show you an illustration today with a smaller company that may produce the most long-term value. But then that doesn't actually happen. Meaning it shows you or it illustrates great looking long-term values, but then it underdelivers and you look back and say, I shouldn't have went with that option. I should have went with a different company that perhaps did not illustrate strong long-term values, but they delivered stronger long-term values. That's where company selection is important, and that's where I do like the 4 major mutual companies, being Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Anyway, I hope that you did find this video helpful. If you did, please hit the like button and subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.